Hi, my name's 𝗵𝗁𝗵𝗿. I'm the head of equities at Schroders, and I'm going to give you a 10-minute update on the portfolio, our thinking about markets and how we're adapting to what's going on at the present time. If I start by looking at our overall portfolio positioning, you can see on this slide that we remain fairly significantly underweight financials, and we also have very small positions in the sectors that we'd say represent the valuation extremes of the market. So we're operating in markets now where, as in the US, information technology, AI, themes around defence, there are a lot of areas of the market where there's a lot of speculation going on, and most of that speculation is around thematics. Our portfolio is positioned to skew away from those speculative excesses and really focus on the sectors that we think there's reasonable long-term value and, most importantly, durable and good businesses. So the sector positioning really does reflect that bias at the moment and caution on those areas of markets that are most subject to those excesses. If I stand back and look what happened in the last quarter, probably the brief summary of it was that market moves are extreme in a lot of cases. We're seeing a huge dominance of momentum investment as more and more money flows into quantitative and index hugging strategies. That's driving very savage price reactions to earnings momentum in both directions, and you're seeing outsized moves in the market across a whole range of sectors. That's driving some fairly extreme performance from fund managers, and it's also, on the bright side, I think, creating a lot of opportunities for people who are prepared to look through that volatility and buy durability and valuation rather than reacting to what is sometimes quite scary earnings momentum. So particularly in the materials sector this quarter, we've seen some fairly crazy moves, dominantly in rare earths and gold, as they are the commodities susceptible to some shocks driven by the US policy, tariffs, etc., and the ongoing spats between China and the US, with China controlling a lot of the rare earth supply, and gold, where it's actually a little bit difficult to know what's driving it, but certainly the sharp rises in the gold price have obviously flown through to some very extreme moves in underlying gold equities. If I dig a little deeper into the market, the one thing that's pretty obvious in Australia is that most of the return is continuing to be driven by rising multiples. So you can see on this chart here, the source of most of the valuation gains in recent years has been those multiples continuing to shift higher rather than earnings propelling the market. So where we don't really align with the US is just on that lack of exposure to AI and the earnings-driven themes where there's a lot of excitement in the US. We can question the durability of those, and we do. But in an Australian context, we're seeing far more anemic earnings growth, and therefore the strength in the market has to be driven by valuation multiples. That's seen multiples move to a level where we're probably pushing historic extremes. That's why we and a lot of other fund managers would probably say now is not the time to throw caution to the wind. When you're sitting at valuation extremes, as Warren Buffett would always warn, the time to be greedy is when others are fearful. They are not fearful at the present time. Just spending a minute on gold, given how important it was to moves over the quarter, we have probably seen, as is often the case when you don't have anchors to commodity prices, analysts, gold prices and valuations of the underlying gold stocks have just chased consensus gold price forecasts. So when there's no cost-driven anchor, what analysts continue to do is watch the gold price go higher, revise up their valuations based on an ever higher long-term gold price. There's not really any basis to believe that the long-term gold price should now be $4,000 just because the current price is $4,000. You can see on the chart on the right, we've now lost all connection with cost curves when it comes to the gold price. What that is saying is just that if you've got an ounce of gold in the ground in any mine in the world at the moment, it's going to be economic to dig it up, because even the highest cost gold producers are making a bucket load of money at current gold prices. You only need to go down to Martin Place and look at the queues outside ABC Bullion to know that FOMO and the momentum behind gold are powerful. The queues are rising with the gold price, but as is always the case with momentum investing, things can change very quickly. And when there's no underlying anchor, as there isn't really with gold, you've got to be a little bit careful as to what are you going to do when the momentum turns in the other direction. We remain pretty cautious on gold given very high gold prices relative to history and a lot of FOMO. Taking the other angle and a couple of stocks where we do think things are interesting, a lot of what we're looking at the moment are businesses that historically have been perceived and are very good quality businesses, but they're out of favour for reasons that we think aren't durable. These are businesses that will go back to being good. You've got to have confidence that the problems are reversible, but in the case of the positions in some of the healthcare stocks that we're adding to the portfolio, we are very confident that these problems are reversible. So in 𝗵𝗵𝗵𝗄𝗃, in very simple terms, this is a business where the value driver is a bunch of Australian hospitals where they own a lot of land and buildings. There's a lot of underlying real estate value, and strong population growth and an ageing population mean that current overcapacity problems, the problems driven by COVID where capacity utilisation went down, all of those things are almost undeniably will reverse over the medium term as those hospitals fill back up again. The poor economics of hospitals mean that no one is wanting to add capacity. You're seeing that with Healthscope going broke. When an industry gets in that situation where it's necessary, good operators like 𝗵𝗵𝗵𝗃 need to make money, but everyone is slashing their wrists because margins are weak relative to history and conditions are tough. That to us is opportunity, where you've got good, durable, long-term businesses that are just experiencing challenging short-term conditions. The offshore situation with 𝗵𝗵𝗵𝗃, while there's a lot of debt in the French and UK situation, the acquisitions of time gone past are awful. The good thing about that is that the debt around those acquisitions is ring-fenced, and we value those hospitals at very little. So if 𝗵𝗵𝗵𝗃 pulled out of Europe and the UK and all of their offshore businesses, we don't think it'd do any meaningful damage to the valuation. And the last one, CSL, again, a big and popular stock that really does fall into the same category. We're looking at a business that has had some self-inflicted wounds over recent years. They've lost some market share, they've let their costs get fat, they have lost some of that advantage in revenue per litre from specialty products, which gave them a revenue and margin advantage over their peers. That coming back to the field has really given them a wake-up call, and again, the good news is that Brian McNamee, the chairman, and the business overall, I think, is recognising the need to cut costs, get back to basics, start winning market share again, and start getting back to the business that was great and made a lot of Australian investors a lot of money through time and has seen it go to being the preeminent plasma business in the world. We do think that they can get back there. They do need to cut costs, they do need to get more efficient, and there are obviously challenges around US tariffs and Trump trying to scare everyone into having to put capacity into the US. But again, no matter what, we still think CSL is in a very good position as long as they can get back to a business focused on operational efficiency and, in very simple terms, being good. So again, that's the quarter. There are some opportunities opening up for in particular these sorts of stocks where durability is great, businesses are great, and conditions are currently tough. We'd certainly urge people to not get too caught up in the speculative frenzy at the moment. Make sure you're looking through the tunnel and you stick to that investment discipline that all long-term investors need when it comes to really growing long-term wealth. Thank you.